You had penciled in a cut in September. So two-part question. One, do you still have that penciled in? And two, let's talk about the cash trap. What do you say to people who have been sat in money market funds all year? What should they do?
So let me start by saying our forecast is still for a recession by year end. And we use Bruce Kasman's JPMorgan models a lot, and the modal outcome is still pointing to recession by year end. We have never gone from the last rate hike to recession without the Fed cutting rates before then. So you have never gone into recession, then they started to cut rates. So if everything we're seeing is still telling us recession by year end, then yeah, I'm still sticking with September as the first rate cut. Yeah, I'm getting a little queasy about it, but I think it's still on the table. In terms of the cash trap, that's the conversation we're having with clients. We've had a fairly significant backup in yields. Forget about the Treasury curve. Just look at the aggregate bond market. Back in March, you were buying it close to a 4% yield. Now you're buying it closer to a 5% yield. That's a pretty good value to us. And I know you can get a little bit higher in cash, quarter, maybe 0.5% more in cash. But if we're right, and we've seen the last Fed rate hike, and the market starts pricing in rate cuts, and they start cutting rates, then those cash returns will start to evaporate, and you'll have locked in not only the carry, but you'll get some capital appreciation from your bond portfolios. It's not something people who have invested in bonds are used to over the last 15 years, capital appreciation in bonds, but we should get that.